Hi there, folks. This is Sean Broderick for Oxford Club. I'm here in San Francisco again, and I'm speaking to Siren Fisekci. She works for Canadian Oil Sands. Now, they're a big oil producer up in Canada, and she just gave a great presentation about why she thinks that it's a company to own going forward. Siren, could you speak to my subscribers about what you think are the major points they should be looking at with your company?
Yes, Sean, I'd be happy to. Canadian Oil Sands is a unique investment in the oil sands space. We own 36.74% of the Syncrude project, which is one of the first operations up in the oil sands. They've been producing since 1978. They benefit from very long life crude oil reserves. We have probably 40 plus years of production at current rates, and then beyond that we have more resources for future development.
Okay, now your cost per barrel is roughly around $41 per barrel, isn't that right?
For 2013, correct.
All right, now, of course, that could go up or down a little, but basically kind of a fixed cost, though. You know, they're always doing things to improve, and they're also investing a lot of money to make things work better there, so there's that going on. The main fluctuation, probably for their stock price going forward, will be how much they can produce, and also the cost of oil itself. Now, as we know, Canadian oil often trades at a deep discount to West Texas Intermediate. In fact, recently it's been like $40 a barrel. Your oil is not discounted like that, isn't that right?
That's exactly right. Another significant advantage for the Syncrude project is that we have an upgrader on site. That upgrader has design capacity to produce 350,000 barrels a day of fully upgraded light sweet crude oil. This is a quality blend that's very attractive to refineries throughout North America. It is actually better in terms of quality than conventional light sweet crude oil.
Okay, now we all know that, again, another problem for the Canadians is actually getting the oil out of the middle of the country. That's always a thing they're working on. But you guys are actually putting new deals in place. You're actually signing up deals as those new pipelines are built to actually ship out more oil that way, right?
We are trying to manage the dynamics in the North American crude oil market right now. The whole market has a lot of production coming in against a very tight pipeline capacity. So we are making commitments on new pipelines and on existing pipelines to help move our product and optimize pricing. And as well, we're making storage commitments so that we can store our product at certain points in time if we're not able to move it, given the dynamics in the marketplace today. Big picture, we would like to have access to global markets, which would require new pipeline builds to the east and west coasts of Canada, as well as the Gulf Coast of the U.S.
Now, there is more than one way to actually get the oil sands. What some companies do is the steam-assisted gravity stuff, and that's expensive. You have to pump in a lot of natural gas. You guys use the big scoops and the big trucks, which is much cheaper, isn't it?
Well, yes and no.
Okay.
So SAGD producers can produce the bitumen barrel, typically for a lower cost than we can, but they're much more sensitive to natural gas price increases. And aside from the operating cost, what's really important to look at is the margin that you receive for the product. When we look at our margin relative to both in situ producers that use SAGD methods of recovery, as well as mining oil sands producers, we receive very attractive margins. They're in the range of $34 to $36 a barrel for the past couple of years. So while it costs us perhaps more to produce the high quality blend that we do, we receive a better price for it in the market, and that's really what contributes to your profitability.
Yeah, that actually puts it in a much better way. I was actually thinking, because you get the light sweet stuff and they don't and all this stuff, but yes, so that works. This company has a big picture view of things, which many companies just don't seem to get a handle on. They've been working on this for years, they know what they're doing, and they have 40 plus years of reserves. All that, plus they pay a nice dividend, which of course will depend on them keeping the profits coming in. Of course, we never want to guarantee anything like that, but it's something that we should be looking at if you're looking for a company that has a big picture plan, lots of reserves, and really has the wherewithal to actually pursue that and actually keep on moving forward and just hopefully having a good year next year. Is there anything else you'd like to add to my subscribers?
I think that's a really good conclusion, Sean. So I'd probably just wrap up by saying that indeed our approach is to offer a high dividend payout reflective of the cash generated in our Syncrude oil sands business, and that is very much reflective of crude oil prices.
Mm-hmm.
We do offer long-term exposure to crude oil prices through our long-life reserves, and we do not hedge any of our crude oil production.
Right. So if you think oil prices are going higher over the longer term, this is a company you might look to buy on the dips.
Correct.
Right. Well, thanks very much for tuning in. Thank you very much for speaking to my subscribers. You folks stay tuned. I'm going to have more stuff for you.
Thanks, Sean.